See, as I said there, that I think there are two extreme, two views. One is of John C. Bogle, who believes in indexing, and the other is Warren Buffett, who believes in active management. I think both are correct if you look at them the right way, and there is no conflict between what they say. So what Mr. Bogle is saying is that, look, if you look at active managers as a group in US, where they own almost half the market, the mutual funds own almost half the market in US, it is not possible when you are 40 or 50% of the market for that half the market to outperform the other half. It is a very mathematical, simple conclusion. And since you don't know which active manager will do well, probably you are better off with active managers. On the other hand, what Mr. Buffett is saying, look, stocks are driven by emotion in the short run. Human beings are very emotional, and markets are always creating excesses, and when you create an excess, you also create an opportunity. So if you think long term, if you are disciplined, if you understand valuations, elementary valuations, you can outperform the markets. And I don't think that emotional aspect of either the markets or human beings is going away. So I think not everyone can outperform the markets, but someone who is able to rise slightly above emotions, think long term, think logically, I think the market does throw up opportunities every now and then. In any case, in India, if you see, mutual funds own just about 5% of the markets. So we are far away from the US situation, where they own 10 times the markets. So I think even the average active manager in India has a far better chance of outperforming the benchmarks than what they have in US.
Prashant, I'd like your opinion on a real life example. A lot of people in the market, among our viewers who closely follow you, their individual portfolios are down 40-50% on a year till date basis, whereas a lot of mutual fund portfolios are down 12 to 15% on a YTD basis. So should they go about putting most of their money in mutual funds? Should they have a balanced approach of trying to do their own stuff to one section of their portfolio and let some of the experts manage the other set? How should the balanced portfolio approach be?
See, I think what we have touched upon, it raises two issues, and one is whenever you are investing in equities. See, in equities you face two types of risks. One is the systemic risks. What is, when whole markets go up, most stocks tend to go up, and when whole markets come down, everything tends to come down. That is one risk which you can reduce only by longer holding periods. You can't do anything about it. But there is a second type of risk in markets, which is the non-systemic risk, which is every business faces different risks. If oil prices go up, if interest rates go up, if currency depreciates, these are good for some businesses and not good for some others. So this risk you can handle it effectively by diversification. And I think mutual funds maintain the discipline of diversification always, which is what some or I've seen majority of retail investors fail to do. And just by having 20 names in the portfolio is not diversification. In 99, people used to have 10 IT or TMT names, and they thought it was diversification. There are high correlations between various businesses or various sectors at a point of time. Recently, if you have bought a few sectors which were highly correlated, you may feel I own 20 stocks, but actually you are not effectively diversified. So I think the first principle is we must always remain diversified, whether in direct portfolios or in mutual funds, effectively diversified, not just in terms of number of names. The second issue what I would like to raise here is, in my experience, and when I say whatever I am going to say applies to the majority, it does not apply to people who are, there are individual investors who are outstanding, who have done extremely well. But I feel the bulk of the investors, they tend to get carried away with the markets. In 99, after IT had done very well, almost everyone was overweight IT, and very few were focusing on other sectors. Around 2008, you could see the same preference in real estate or capital goods. No one was talking about FMCG or pharma in 2008. And last few years, we have again seen a similar focus on certain sectors or certain caps. So I think whenever, what does this tell us? It tells us that people are simply extrapolating the last few years' performance over the next few years. So whatever has gone up sharply is likely to be more expensive. But people think they simply extrapolate, and that is why many investors are disappointed with the outcome.
Prashant, you spoke briefly about that market starts building in excesses time to time in sectors, in pockets, or market as a large. How should investors, or how you sign those excesses or spot them? And do you think there was a case for excesses getting built in mid and small, say whole of 2017, second half of 2016, and hence all of that corrected this first half?
See, to spot an excess is not difficult at all. What is very hard is to go against the flow, is to go against what seems to be making money every day. So in 99, everyone knew that IT companies are trading at few hundred P's, and non-IT companies were trading at low or mid single digit P's. Similarly in 2008, I mean, real estate companies were more expensive, market caps were bigger than consumer companies or IT companies.
Sure.
So I think it was not hard to spot. The challenge was to go against. I mean, how do you say, let me buy something which is probably value but is not performing, and ignore what is going up?